Hello, guys. My name is João Mischiati. I'm from Brazil, but I operate in both markets. In Brazilian markets, that's very different, and the United States market. And I'm doing this channel so I can actually teach or help some people and show what I'm gonna do and give you sometimes some advices. Of course, just this is disclaimer. You it's just an educational, yeah, it's not nothing like a recommendation, but I'm going to teach you very quickly about what you can do with options, yeah, and especially this video selling options. But when we're going to advance the what I'm going to talk about, I'm going to teach you some hedges or some different structures, more about like a European kind of view or Asian view, not just American. Yeah, American, we try to find more opportunities. But of course, here I'm going to try to find some opportunities. It's not going to make you a lot of money, not like 300% a year. Most of the time I use sell and buy puts long, or doing some kind of different structures that I'm going to talk about, like straddle put, straddle call. It's different, and I do a lot of hedges to protect. I know here we use a lot of back tests. I'm not gonna use it. I like it, of course. It's really good, but what happened in the past is in the past. I don't think it's gonna happen the same thing in the future. So if you don't have to trust a lot of on back tests. I know test works, use a lot of back tests, and you see 2 years it wasn't really good what happened. If you just bought the stocks, would be much better. But if you do at least a Monte Carlo simulation, it's going to be much better, because then you can, it's much more variables, and of course it will show more the what can and what can and what could happen on your investments. But here it's going to be more like reasonable, okay? So I'm going to talk about this first time, just puts, what is puts and what are calls, and show some examples. So let's check here. Okay, what are options? Options are financial contracts that grant the right to buy or sell assets or stocks or ETFs at a future date for a fixed price. But you gain this option premium. The buyer of an option pays a small amount known as the premium to obtain the right to buy or sell the asset. Okay, what is that? There are two types of options, call and put. I'm going to just talk about put. If I want to buy a stock for a determined price, for example, I want to buy Visa with and Visa is like $300. I don't know what's the price of stock. I haven't bought any. I don't buy stocks, and so like example is $300, and I can sell a put, and for an obligation to buy a $270, and I gain some money to do that. I don't know, $1, $2 per share, for example. And if it goes down of 270, like $250, I'll have to buy for 270. If it's still up, if in the time, if that time, like a month, it's going $280. I just gain the price and nothing happens. I don't need to buy a stock, and I can sell puts again. But a lot of rich people do that, like Warren Buffett and other kind of rich people. But there's the opposite way. Some people buy puts, buy protections, buy, they say hedges. Yeah, I don't like it, this kind of hedges. But I buy a lot of puts too. You see when I'm gonna talk about some more advanced structures. But let's say why people buy stocks, buy puts. Okay, think about they they buy puts to protect themselves and preserve their assets, especially big players that are some managing the money of their clients. Why? Because they think that when you, for example, imagine if the market goes really down 20, 30%. Most of the time they recover and goes up again. But if people see that happens, they take out of money and gonna replace in another fund. So they're really really afraid to goes down. They always want at least the fund stable or maximum because they want to that the clients stay with their funds. So they are like afraid, and so they buy puts. And for example, other example, you bought QQQ at $500 and don't want to lose money. So you can buy a put. So you protect, and if it goes up, you still gain. And to develop more complex strategy, you can sell puts. You can sell one put and buy another put in different strikes or in different expiry dates. And traders who believe in a bear market. Yeah, so you can make a lot of money with the options like this. I don't just buy puts. I just buy if I'm selling something. Okay. Here, I like the source of Robinhood. It's a platform that popularized options, especially in the United States. And they always say this: the democratizing investments for everyone means expanding access to import financial tools that were previously available only to the well-filled. So in this channel, I'm going to show some different structures. Hope you guys like. It's going to start with the beginners, intermediate, and advanced, but it's a different perspective. Like I said, I wanna do more the view, not American view, but more European views and Asian view that you can also make money. A lot of Asians probably make money here in the United States or Europeans using their market. And I like the I like I think it's easier to make money here in the United States with the options than, for example, when I live, that's in Brazil. Of course, there is a different kind of opportunities, but here there are more opportunities, and you have to check this channel so you can learn different things. Okay, I'm going to stop here, and I'm going to show my. I'm going to show some examples of selling puts can be really good. This is my account, and I use interactive brokers, and it's a margin account. For my structures, that's what I need. So I can sell, sometimes I even sell naked calls, imagine, wow. But of course, with really reasonable, yeah. And let's, I'm going to show you some examples. For example, Visa, here with P, you can go options chain. Here is going to show you volatility. I'm not going to use IVE ranking, okay? But I can compare volatility here. If you have a lot of 7 days, here is strike 21% of volatility. With this, if this is higher, it's better premium, okay? And Visa is a good company. Here's 22%, December 21.7. Here is 21.3. So let's say you want to sell for 21 days and it's 339. You're going to sell 335 a put. You come here, sell one one is equivalent of 100 shares, so it's a lot of money. If you sell this, you have and really goes down, you have to buy and 33,500 dollars because it's going to be 100 shares. And in return, you say, oh, it's not a lot, it's just 520. But if you can compare 5.15 of 35 is like 1.5% in less than a month, in 21 days. So it's good, especially if it goes up. Yeah. And if you do this continuously, you can make some money. Of course, if it goes down, it's a problem. It's much better that especially puts American puts, so you can exercise all the time. So you can do much more hedges than in another places that is European options. So I'm not going to talk about this difference, but European options you cannot exercise, yeah, and here you could exercise. So you could exercise anytime. So the time you extend the strikes, you always, not always, but most of the time you do positive or pay 2 or 3 cents. So it's really cheap to maintain your position. Okay, clear that. Visa, you can do ETFs, QQQ, for example. Oh yeah, I like ETFs. For like, there's every day, yeah, can sell for, but the IV rank is lower. You can do Tesla. It's, for example, then you can see the difference of premium. Okay, so let's say for it's the same example, 21 days. Okay, I'm not showing you which one is better. I don't like to do that. Like, oh, 45 days better, then you close 21. I don't use this kind of thing. But here you can see that if you sell for the volatility is 55%, it's much higher. And if you sell for, if you want to buy for 450, you gain $21. It's much more. Yeah, it's like almost 5%, it's 4% something. It's a lot of money. But of course, it's a lot. It's too expensive. Yeah, that was $456. So 100 shares will cost $45,000. Yeah, but you gain $2,050 just for doing that, just promising to buy a 450. And if it goes like 445, you can do the rolling and to buy for this. Let me say example. You can buy November this expiring date. For example, I could buy 460, yeah, that is expiring today, and sell for like no, and sell for $26, I would gain $19 just doing that. Yeah, if I had sold 460 put. Yeah, so I always making money like that. But if it goes really down, then you won't be more positive, and then you have to do something or just buy the stock. Remember, buying stock, you have the you need the money to buy stock, or um, if you have the money but you don't want to buy now, you can do some hedges. So you still don't pay to do. You earn a little bit more, but you have, of course, some different kind of risks. Always you always have some small risk here. But if you don't have a lot of money, there are a lot of stocks that's like $10, $12, $8, $5, $1. Then you're not. It's easier for people who don't have much money. Okay, I know the my English is not really good, so I hope you understand. I hope I can give you some advice, some different structures, and then maybe I can show you later on my performance. Yeah, here's my portfolio. Yeah, I can show later on my performance. Here's this account I started in May, and I I put my money here, so I gain more, almost 40% in 6 months. But of course, this is just a account that I don't have a lot of money. Yeah, and you have to understand that, because if you make 40% a year for like 4 years, you multiply your your money for like four. Yeah, it's 40% is like almost two times. You double your investment in almost 2 years. A little bit more, yeah, but you can see 40%. You double your money in 2 years. Of course, with this strategy, you never make that. Yeah, just selling puts, it's almost impossible. And one time is gonna, unless if you are doing really really big. So I always try to be I always try to manage my risk. Really, really, this is really, really important. Manage your risk. Okay. Hope you like. If you like, you can like this video, and we can talk about. I can. I'm gonna record more videos showing some what you can do.